Hello, friends. It's your old pal PeaceLoveMusic here with a DeOrganized live breaking update of what's going on with the FOMC meeting. I have with me today GPSC, Jackbinswitch, reporting in from his phone on location, and CryptoLandy, who is about to have a lunch break, but he will be with us shortly. And we are here to talk about the FOMC, current the Fed rate launch and the FOMC meeting. We're going to cover the meeting, which should be going live shortly. I think that the rate dropped. I don't have the news story in front of me yet, but I believe rates are going to be unchanged. Does anyone actually have a confirmation on that?
Yeah, I think Landy, did you just confirm that rates stayed flat just a minute ago? Let's see.
You went to grab lunch right as we were going live, which is fine.
I got something here. It says Federal Reserve leaves interest rates unchanged, remains 4.25% to 4.50%. Yeah, so it looks like they stayed flat.
And that was what was expected. So there's not a lot of that shouldn't shock the markets in either direction. There shouldn't be a lot of action going on, but let's check out and see what markets having any response to that right now. Bitcoin's flat on the hour, or actually about down 1% on the hour, but it's up 2.74% on the day. So up at 83,608. It looks like it's dropping though a little bit. So maybe, I don't know whether people actually thought they were going to get a rate cut.
Yeah, I feel like
markets look like they're pretty flat right now.
Yeah, I think people were feeling like they may have been some bullish news, like a cut, but nothing. Of course, nothing happens, and then we're gonna hear Jerome talk, and then everybody knows when Jerome talks, the market might get a little volatile, even though that the rates were uncut, depending on if he's dovish.
Right now is up 0.5%. S&P is up 0.5% on the day. Nasdaq's up like just over 0.5% on the day. Dow's up just under 0.5% on the day. So it doesn't look like markets are making big moves on the news. And as always, though, we want to see what the chairman has to say, and we'll be covering that live in about 20 minutes to see what's going on with that.
It looks like on the announcement of the news, we're starting to see up and down action here. Like here, I'll even go down to the minute chart just to kind of show how volatile it does get on these days. All morning long, it seemed like uptrend, and then now on the announcement of the rates being unchanged, We get sharp move, sharp down, and it's really just chop sideways. It's really nothing to look at, nothing to really talk about right now. But whenever he opens his his mouth, it starts to get a little bit nutty.
Right.
So
exactly, it moves the markets.
Yeah, and then of course, whenever Landy's back
Yeah,
from his lunch break.
Hold on, let me. Reese is asking to join, so let me get him the link. He can absolutely come join us.
No, Reese, you're not allowed to come join us. No. Of course, dude, come through. Yeah, I'm just gonna leave it here on the minute chart for a minute. Just the show, chop, I guess. While we wait on Jerome to start opening his mouth. Yeah, it's one of those things, and then I'm gonna go do the thing, the one thing that we do, where magic happens. So
yeah, I'm gonna actually. That's cool, man. You do your thing, Jack. What do you think? How you doing, man? Is Jack with us still?
Yeah. A little technical difficulties thanks to Apple, but I think we're doing okay now.
Come on, Apple,
man.
Should have gone with this.
Here, let's have some fun with it. We got the 1 minute chart open. How about we make some 100x leverage longs here? See if we make something happen on the 1 minute chart.
DJ on the 1 minute, 200x leverage, not financial advice. Yeah, DYOR.
Yeah, not financial advice. 200x leverage.
But send
Stella Kidney. Powell speaks. Yeah. No, man. I don't know. I was listening to Landy speak earlier on a different space about kind of like the macroeconomic environment. And I mean, the way I feel about this is all pretty simple right now. Literally day in and day out, we are just, inundated with bullish catalysts for Bitcoin. So whether he, keeps rates the same today or drops them a little bit, I mean, it doesn't change my thesis at all, right? I
opened up his screen there, Peace, for a second. Sorry to jump in, Jack.
Yeah, Landy, what's up? Well, go ahead, Jack, continue, please.
Yes.
And then Landy can show us what he wants to show us.
Yeah, no, I look, I don't have enough Bitcoin. I need more Bitcoin. That's nothing changes.
That is financial advice. That is financial advice you will get from this show. You can't have too much Bitcoin.
No, I mean, look, it's people are starting to finally, understand that it's okay to learn about Bitcoin. It's okay to form an opinion about Bitcoin, and it's okay to even get some. And we have a whole new generation now being exposed. Even if its number go up at first, the fact is this is an asset that is better than gold. And it's the asset. It's the future money. It's the best form of currency ever created. It's a network that's decentralized and secure and opens up a whole new world. So I'm bullish Bitcoin regardless what happens. Me personally, and again, I'm just some idiot. I'm not a financial advisor. I believe the bottom's in, right now anyway. I think sentiment hasn't caught up to that yet. But even if we, chop sideways a little bit longer, that's fine. That's just all a more opportunity to get more Bitcoin.
Right. I would absolutely disagree with you on the notion that you're just some idiot, Jack. But you're not a financial advisor, and that is true. And neither, that's not what we're doing here. But we do talk about these things, and we're very passionate, and we really do believe in Bitcoin, especially. We're all huge fans of Bitcoin and the technology, the aspect of it, the ethos, what's behind it. And so when we say you can't have enough Bitcoin, we believe that. Now, that doesn't mean that you should go out and take unrealistic risks to accumulate Bitcoin to try to. It's not a windfall in a major windfall in a short period of time kind of thing. It's accumulate and accumulate and accumulate as much or as little as you can at as much at the time, as much as you can at a time, whether it's a $5 worth or $5,000 worth, and average in and take precautions and don't risk money you can't afford to lose. But if you have savings, by all means, don't hold it in dollars when you can actually, put it into Bitcoin. If you are going to hold it in dollars, by the way, make sure it's USDH Hermetica dollars that are backed by Bitcoin, and you can earn yield over at Hermetica.fi. But by all means, accumulate
I'm
Bitcoin.
glad you said that.
Institutions are coming in.
That's going to be the bullish conversation I can't wait to see happen, is when we get like some more clear-cut regulations on stable coins. Everyone's always like, look, you fall into one of two camps. You either are like, okay, what do I do for an off-ramp for my crypto or my Bitcoin? Or you're like, I don't want to spend my Bitcoin, but you still have to transact. And stable coins play such a huge part in that. And yeah, that's 100% right. That's going to be the bullish stuff. Like when you see, more vendors taking stable coins, when you see stable coins being used at point of sale terminals in real life and things like that, that's when you know that mass adoption is like into its next level. And we should be hearing some news about that kind of stuff soon, here in the US. So
yeah,
extraordinarily
and more often as it goes too. Yeah, it's great stuff going on in our ecosystem.
Reese, what's up?
Hello.
How are we doing, sir?
Hey.
Dude, I am just so bullish with the rest of y'all. I don't know. Today I was just like revamped in my energy for stacks and everything Bitcoin related. Like it was just like a re-zen of don't fucking care. Everything's gonna be fine. And just like focusing on what's happening in the space, in the ecosystem itself with what everybody is building. Last night, the art on stack space was so freaking bullish. It's just like, I think it opened up my mind to, there's so many people who don't even know about stacks yet. And once they do, once they're on here, it's just going to be so great having a lot of my friends from Ethereum and steal them over for a year. By the way, hi guys. Hi GPSC. Hi Peace. Hey Jack. Hey Landy.
Hey Reese, what's up, my brother? Yeah, that was an excellent episode of Art on Stacks on yesterday. Yeah, it was just yesterday. I was going to say on Tuesday, but that was just yesterday. And I love what I can't remember her name, but she was just magic.
Coraline.
Yeah, she's such a cool person, man. You know some really excellent people. Actually, we're gonna have your boy Darbles come on, who's got his first BTC art collection launching over this weekend.
Yeah,
he's gonna come on Friday morning and chat with us for a few minutes about that.
Yeah, I remember when I was like just joining Stacks and I was getting ready to launch my first inscription. I was like, to everybody I was talking to, I'm like, dude, why don't you have art on Bitcoin? We all need to have art on Bitcoin. Let's just move. Let's focus. And I don't know. I'm not claiming credit for that, but I hope it sparked some inspiration that he started looking into that, or that he decided to take a collection that he was working on to that. GPSC, you damn creative brother of mine. What are you doing?
Moving things around, making magic happen. You already know, man. I do wanted to just like echo exactly.
Wait, I need to take a picture of that.
It was awesome, dude. Oh, I'm not making this. This is Landy. Landy will be with us.
Oh,
I thought you were talking about like moving my mic around and stuff.
Yeah, Landy's gonna come and actually like make us all look. Jack's doing a good job. Jack's got some good information and intel on the situation, but then Landy's gonna come in and make us look better than if it was just me and GP and I love you too, Reese, but if it was just the three of us, this might not have as much weight as far as our
Yeah.
analytics of what's going on and what's to come out of it.
Yeah, we're artists and degens, dude. This is what we do. Like, we degen, we're in the trenches, we're contributing to the culture while giving you live coverage. There you go. Big old point. Bitcoin. Get you some Bitcoin. That looks slick. Looking good. Landy is a chartist. See what I did there? He is an artist / charter. So he's a chartist.
Chartist. He's a chartist.
Yeah, so he'll be jumping in with us in just a minute. But yeah, I do agree that Landy brings an awesome take. The way that he brings articulates what's going on. You know, he's very gifted. And big shout out to Jackbinswitch keeping us ahead of the curve as always. Also awesome takes always.
At the Zest Town Hall, like Landy was ripping, man. I was just like taking notes about everything he was saying, and I think that contributed to the fact that I was so freaking bullish, and I just like bullish on everything. You know, no price is reflecting the reality of any really chain, like big chain right now. So I mean, it's all just lagging in my opinion. But it's all good. It's more time, you know, for me to try and find a plasma center where I can sell my plasma and get some liquidity going.
Dude, hey, I just set up my my feet finder profile. So I very, what is a relatable statement there, sir? You know, finding the closest plasma center, setting up that profile on Feet Finder, even spinning up an OnlyFans to get more Bitcoin.
You've heard of OF? Well, here's FF.
Yeah, very cool. Hey guys. Hi Reese.
Hey Landy. I was about to say, during, I think it was a Goxstein space yesterday, they actually advised, like, if you're under 5K, under 10K liquidity right now, go get a second job. And you know, I'm not knocking it. It might be a good idea right now to just get more liquidity, because this is really setting me up for more good things to come in the future. So I'm not against it. And you know, GPSC with his feed finder, that is, dude, if you got the feed for it, I unfortunately do not, but I might actually consider an OF, you know, just might fuck around and not joke around.
Yeah, dude, I'm telling you.
At Foot Finder, they believe that there is a fan for every foot.
That's very true. See, I got the long French fry-esque toes. So there is a certain demographic of feet collectors that like my feet.
At least yours don't look like fucking. Wait, I can't even use that analogy because you guys don't even know what that chips looks like. That crisps.
Uh-oh.
Sorry, Americans.
All right, Andy, what's up, dude? You got something for us?
I want to give you guys some alpha real quick here before Powell starts to speak, and then we can go right back to selling pictures of our feet on the internet.
So Bitcoin. It's for a good purpose.
Yeah, so Bitcoin has been at this inflection point, which is very funny that it literally spiked right to the daily basis band, right at $85,000. For those that follow any of my analysis, we've had this level on our charts for a very long time. Some context, post-expansion from the range down here, we had our first bear candle come in with a wick low post-expansion right at $85,000. This has been acting as a bit of an inflection point, or a pivot for price action. And in the lower term timeframes on that minute chart, you can see that after the rate decision, we had a nice spike up to it, rejection, and then a little bit of a sell-off from there, and then a move back to grab some liquidity from the top side here, trying to hold the range here. This needs to be broken by the bulls and preferably closed above. If that were to happen, I do think that we can start to target the bullish half of the bands here. The basis band is a 20 simple moving average for all the moving average folks out there. And that's just looking back 20 periods to get a generalized smooth out price spot that is interesting for that particular 20 period moving average. That is the basis band of Bollinger Band. So in terms of volatility, there's two big areas to pay attention to. Overhead, we have, if 85K is broken above and closed above, in the lower term time frames, we do need to see follow through on the daily. We need to see this swing high taken out. We would get a nice swing high or low, take out just above 85 at 85,318, and then we can start looking for a possible test of the range lows that Bitcoin broke down from. Tried to reclaim, got rejected, sat where? 85. Tried to put in a higher low and come back up, got rejected again before making new lower lows. This is going to be a key area overhead. It's confluent with support and resistance. It's confluent with volatility levels of interest. Upper first and upper second are bracketing right around $88,700 to $92,000. There's also a key level in here right around the weekly. This is a weekly higher low at 89, right in that area. 89 to 90 is a key level where we saw the hedge funds unwind their spot ETF positions and help break us down from this range. The range lows have been holding up pretty well. If price does not get above the basis, continues to reject and comes back down to the bottom side, watch somewhere around 81.5, all the way down to the low side structure at 78.5. Anywhere below there, we're running the actual lows again and possibly low around 76,555. Maybe even lower to go in and test last year's big accumulation area where we had the top side coming in at 73,835 down to a weekly high area at 68,000. So just be aware that lower term time frame volatility post what was already expected in terms of rate decisions. We expected no change. We got no change. So now it's all going to come down to what is the feel that we get from Powell here in about 5 minutes. Just wanted to get that out of the way. Main reason that I've been watching price in some of these key areas. And if you identify levels right and you do it well, you'll get perfect strikes like what we've seen quite often in our analysis. And it's not difficult. Make sure you watch the Tuesday videos. And that is, of course, Learn TA with Landy. And of course, peace, love, and the rest of you. So wanted to get that out of the way. Let's talk feet pick volume. Do you think that volume is going to go up or down from here for feet picks?
I think if the short-term volume goes up.
Yes,
go ahead, GP.
Yes, it's very specific metrics depending on like supply and demand dynamics with feet picks. So whenever like say for winter time and like nobody is like got any type of sun on their feet, we see that kind of like the demand adjust accordingly. So depending on the season and the time of year and the place in the world that you are located, the demand fluctuates and it's very volatile during different seasons of the year. During the summertime, actually, is whenever we see demand for feet picks go through the roof. So supply,
why?
Following closely with the demand. So we'll see the price for feet picks in the summer go into a premium, right, Landy?
I'm curious to hear Reese's reasoning as to why the demand for feet picks is going up.
Go on,
Because
Reese.
the
We're
feet-
going to throw to you.
Because the feet and thus the socks during this time are absolutely moist. It's moist from the sweat. So it just makes sense to me. And GPSC, if I may, I'd like to add to that what I foresee in the next month or so is retail testing the waters a little bit by just steadily going from ankle picks to more like toe picks and then going full on feet picks. So that is where I see the market might head in the next month or so. April's going to be an excellent month, I think.
Kind of like the Roaring 20s, like you show just a little bit of the ankle, right? Like whenever the time's right to get to make something shake, right? And then like if you're not liking the conversation enough, you might just like pull the skirt down just a little bit further, right? And try to cover up most of the feet, maybe just a toe poking out. Yes, I do see a good point there. Very, very good point. And I like the point that you also made about the moist and dry and the fresh dynamic that you did there. Very, very, very good stuff there, Reese.
I don't know about you guys, but when it's winter, everything seems to retract, if you know what I mean. So it might be.
Yeah, but in all seriousness,
You
like,
guys.
it's flat, guys. It's flat. You know, it's unchanged. We're waiting for Jerome to come talk, and it might go up, it might go down, but really, it's only sideways. If you look on a bigger time frame, looks like everybody's starting to get into this meeting. Looks like Jerome is about to come on stage and do his thing, right?
Is there a possible bitrate issue here? Because this is stop motion video right now.
That's what it's
Yeah.
that's what it's showing on my end too. Is like, what is that?
Oh, really?
Maybe try to chat. Maybe try
Yeah.
to close the chat and see if that helps a little bit. That X right there in the top right.
Oh, the
of
chat
that-
there.
Yeah, close that and see if that helps. There
Might
it
help
is.
it.
Yes.
A little bit, yeah.
Yeah.
All right, maybe that's. I'm then just gonna close down a couple of other tabs that I don't need. Let's see.
I like how Marty Party has like closed his comment sections while he's commenting on the FOMC, so I cannot, do the thing.
Marty party. Yeah, and so you're gonna be like, the market makers rejected it at 85. They're trying to get your stops, and they're manipulating the bitcoins.
The bitcoins. Oh shit. Oh no,
Honestly,
know.
man, the thing is unstoppable at this point, isn't it?
What's that?
you can't fade it, so you might as well join it.
Is it? Right. Just the how we do sometimes.
You know.
GP knows what I'm talking about. We're speaking in code.
Yeah, doing the thing about redacted. Right? Anybody following me? I know pieces. That's okay. All right, so let's hear what this guy
It's all right.
has to say. Can we get some audio, possibly?
Oh yes.
Remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. The economy is strong overall and has made significant progress toward our goals over the past 2 years. Labor market conditions are solid, and inflation has moved closer to our 2% longer run goal, though it remains somewhat elevated. In support of our goals, today the Federal Open Market Committee decided to leave our policy interest rate unchanged. We also made the technical decision to slow the pace of decline in the size of our balance sheet. I'll have more to say about these decisions after briefly reviewing economic developments. Economic activity continued to expand at a solid pace in the fourth quarter of last year, with GDP rising at 2.3%. Recent indications, however, point to a moderation in consumer spending following the rapid growth seen over the second half of 2024. Surveys of households and businesses point to heightened uncertainty about the economic outlook. It remains to be seen how these developments might affect future spending and investment. In our summary of economic projections, the median participant projects GDP to rise 1.7% this year, somewhat lower than projected in December, and to rise a bit below 2% over the next 2 years. In the labor market, conditions remain solid. Payroll job gains averaged 200,000 per month over the past 3 months. The unemployment rate at 4.1% remains low and is held in a narrow range for the past year. The jobs to workers gap has held steady for several months. We're growing faster than inflation and at a more sustainable pace than earlier in the pandemic recovery. Overall, a wide set of indicators suggests that conditions in the labor market are broadly in balance. The labor market is not a source of significant inflationary pressures. The median projection for the unemployment rate in the SEP is 4.4% at the end of this year and 4.3% over the next 2 years. Inflation has eased significantly over the past 2 years, but remains somewhat elevated relative to our 2% long-run goal. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.5% over the 12 months ending in February and that excluding the volatile food and energy categories, core PCE prices rose 2.8%. Some near-term measures of inflation expectations have recently moved up. We see this in both market and survey-based measures, and survey respondents, both consumers and businesses, are mentioning tariffs as a driving factor. Beyond the next year or so, however, most measures of longer-term expectations remain consistent with our 2% inflation goal. The median projection in the SEP for total PCE inflation is 2.7% this year and 2.2% next year, a little higher than projected in December. In 2027, the median projection is at our 2% objective. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to maintain the target range for the federal funds rate at 4.25% to 4.5%. Looking ahead, the new administration is in the process of implementing significant policy changes in 4 distinct areas: trade, immigration, fiscal policy, and regulation. It is the net effect of these policy changes that will matter for the economy and for the path of monetary policy. While there have been recent developments in some of these areas, especially trade policy, uncertainty around the changes and their effects on the economic outlook is high. As we parse the incoming information, we're focused on separating the signal from the noise as the outlook evolves. As we say in our statement, in considering the extent and timing of additional adjustments to the target range for the federal funds rate, the committee will assess incoming data, the evolving outlook, and the balance of risks. We do not need to be in a hurry to adjust our policy stance, and we are well positioned to wait for greater clarity. In our SEP, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate based on what each participant judges to be the most likely scenario going forward. An admittedly challenging exercise at this time in light of considerable uncertainty. The median participant projects that the appropriate level of the federal funds rate will be 3.9% at the end of this year and 3.4% at the end of next year, unchanged from December. While these individual forecasts are always subject to uncertainty, as I noted, uncertainty today is unusually elevated. And of course, these projections are not a committee plan or a decision. Policy is not on a preset course. As the economy evolves, we will adjust our policy stance in a manner that best promotes our maximum employment and price stability goals. If the economy remains strong and inflation does not continue to move sustainably toward 2%, we can maintain policy restraint for longer. If the labor market were to weaken unexpectedly or inflation were to fall more quickly than anticipated, we can ease policy accordingly. Our current policy stance is well positioned to deal with the risks and uncertainties that we face in pursuing both sides of our dual mandate. At today's meeting, we also decided to slow the pace of decline in our balance sheet. Since we began balance sheet runoff, our securities holdings have declined by more than $2 trillion. While market indicators continue to suggest that the quantity of reserves remains abundant, we have seen some signs of increased tightness in money markets. Beginning in April, the monthly cap on Treasury redemptions will be lowered from $25 billion to $5 billion. Consistent with the committee's intention to hold primarily Treasury securities in the longer run, we are leaving the cap on agency securities unchanged. This action has no implications for our intended stance of monetary policy and should not affect the size of our balance sheet over the medium term. The committee also continued its discussions as part of our 5-year review of our monetary policy framework. At this meeting, we focused on labor market dynamics and our maximum employment goal. As we have indicated, our review will include outreach and public events involving a wide range of parties, including Fed Listens events around the country and a research conference in May. Throughout this process, we will be open to new ideas and critical feedback, and we will take on board lessons of the last 5 years in determining our findings. We intend to wrap up the review by late summer. The Fed has been assigned 2 goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. we at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I will look forward to your questions.
Howard Schneider with Reuters. Thanks for your time. So two things on sort of the real side here, inflation and then GDP. How much of the higher inflation forecast for this year is due to tariffs? And since the policy path remains the same, are you effectively reading this as a one-time price level shock?
Okay, so how much of it is tariff? So let me say that it is going to be very difficult to have a precise assessment of how much of inflation is coming from tariffs and from other, and that's already the case. You may have seen that goods inflation moved up pretty significantly in the first 2 months of the year. Trying to track that back to actual tariff increases, given what was tariffed and what was not, very, very challenging. So some of it, the answer is clearly some of it. A good part of it is coming from tariffs, but we'll be working, and so will other forecasters, to try to find the best possible way to separate non-tariff inflation from tariff inflation. In terms of your sort of looking through question, too soon to say about that. As I've mentioned, it can be the case that it's appropriate sometimes to look through inflation if it's going to go away quickly without action by us, if it's transitory. And that can be the case in the case of tariff inflation. I think that would depend on the tariff inflation moving through fairly quickly, and it would depend critically as well on inflation expectations being well anchored, longer-term inflation expectations being well anchored.
Well, I guess I'm looking at the out years here, and the fact that the policy path doesn't change at all, and inflation is unchanged in the out years also. Doesn't that imply you all have basically decided that there is no signal here, and that it's just we're back to transitory again?
So I think that's kind of the base case. As I said, we really can't know that. We're going to have to see how things actually work out. And the fact that there wasn't much change, I think that's partly because you see weaker growth but higher inflation. They kind of offset, and also, frankly, a little bit of inertia. When it comes to changing something in this highly uncertain environment, I think there is a level of inertia where you just say, maybe I'll stay where I am.
Thank you. Colby Smith with the New York Times. You just described inflation expectations as well anchored, but has your confidence in that assessment changed at all, given the increase in certain measures and the high degree of uncertainty expressed by businesses, households, and forecasters?
So on inflation expectations, of course, we do monitor inflation expectations very, very carefully, basically every source we can find, and short-term, long-term, households, businesses, forecasters, market-based. And I think the picture broadly is this. You do see increases widely in short-term inflation expectations, and people who fill out surveys and answer questionnaires are pointing to tariffs about that. If you look in the survey world, if you look a little further out, you really don't see much in the way of an increase. Longer-term inflation expectations are mostly well anchored. If you look at the New York, for example, and you have market-based, and it's the same pattern. People in markets are pricing in break-evens. Some higher inflation over the next year must be related to tariffs. We know from the surveys, but if you look out 5 years or the 5-year forward, you'll see that break-evens are either flat or actually slightly down in the case of the longer-term one. So we look at that, and we will be watching all of it very, very carefully. We do not take anything for granted. It's at the very heart of our framework, anchored inflation expectations, but that's what you see right now.
And how much weight do you put on the deterioration in consumer confidence surveys? You said recently that this is perhaps not the best indication of future spending, but I'm curious, what you think is behind this deterioration, and to what extent it could be a leading indicator for hard data.
So let's start with the hard data. We do see pretty solid hard data still. So growth looks like it's maybe moderating a bit, consumer spending moderating a bit, but still at a solid pace. Unemployment's 4.1%. Job creation most recently has been at a healthy level. Inflation has started to move up now, we think partly in response to tariffs, and there may be a delay in further progress over the course of this year. So that's the hard data. Overall, it's a solid picture. The survey data, both household and businesses, show significant rise in uncertainty and significant concerns about downside risks. So how do we think about that? And that is the question. As I mentioned the other day, as you pointed out, the relationship between survey data and actual economic activity hasn't been very tight. There have been plenty of times where people are saying very downbeat things about the economy and then going out and buying a new car. But we don't know that will be the case here. We will be watching very carefully for signs of weakness in the real data. Of course we will. But given where we are, we think our policy's in a good place to react to what comes, and we think that the right thing to do is to wait here for greater clarity about what the economy is doing.
Nick Timrose, The Wall Street Journal. Chair Powell, Chair Greenspan once defined price stability as an environment in which inflation is low and stable over time, but it doesn't materially enter.
Du wurdest für versteckte Buchten gemacht. Wir wurden dafür gemacht, Ersparnisse bei Reisepaketen zu sorgen.
Buy in advance, psychology, big changes in inventories, and surveys that show consumers, at least in the short run, expect higher inflation.
So I do like that definition a lot. In fact, I used it at the recent conference where I spoke. So I think a world can make their daily economic decisions in businesses, and they're not having to think about the possibility of significantly high inflation. We know inflation will bounce around. That is price stability. I think we were getting closer and closer to that. I wouldn't say we were at that. Inflation was running around 2.5% for some time. I do think with the arrival of the tariff inflation, further progress may be delayed. The S&P doesn't really show further downward progress on inflation this year, and that's really due to the tariffs coming in. So delayed, but at our forecasts, we do see ourselves getting back into the low twos in 26 and then down to 2 by 27, of course, highly uncertain. So I see progress having been made toward that, and then progress in the future. I think that progress is probably delayed for the time being.
If that's the case, why are there cuts in the S&P for 2025?
So again, people wrote down 2 cuts the last time, and they look at they wrote down meaningful decline in growth from 2.1 to 1.7 in 2025, a tick up in the unemployment rate, so not much there, but core inflation up by 0.3, and so those kind of balance each other out. So people, not everybody, but on balance, people wrote down similar numbers. The changes aren't that big. The other factor, though, as I mentioned, is just really high uncertainty. What would you write down? I mean, it's really hard to know how this is going to work out. And again, we think our policy is in a good place. We think it's a good place where we can move in the direction where we need to. But in the meantime, it's really appropriate to wait for further clarity. And of course, the costs of doing that, given that the economy is still solid, are very low.
Edward.
Thank you, Mr. Chairman. Edward Lawrence with Fox Business. So with near 4% unemployment rate, that should be low enough to bring people in from the sidelines in terms of hiring. But we're seeing the hiring rates have been stuck at 2023, 2024 levels. So what's going on there? Yeah,
so that's a feature has been for some time a feature of this labor market. You have pretty high participation accounting for aging. You've got wages that are consistent with 2% inflation, assuming that we're going to keep getting relatively high productivity. We've got unemployment, pretty close to its natural level. But the hiring rate is quite low, but so is the layoff rate. So you look at initial claims or layoffs, so you're not seeing people losing their jobs, but you're seeing that people who don't have a job having to wait longer and longer. And, the question is, which way does that break? If we were to see a meaningful increase in layoffs, then that would probably translate fairly quickly into unemployment, because people are, it's not a big hiring market. We've been watching that, and it's just not in the data. It hasn't happened. What we've had is a low firing, low hiring situation, and it seems to be in balance now for the last 6, 7, 8 months. That's where we are. There's healthy levels of job creation too. So overall, it's a labor market that's in balance, and we watch it very carefully.
So then, have we seen the new administration's policies in the economic numbers yet? And when do you anticipate that happening?
In labor or in other?
In labor and inflation, just across the economy, have we started to see the new policies take effect in numbers?
Only in a kind of an early way. I mean, it's only been a few months, right? For example, the layoffs that are happening here are, they're certainly meaningful to the people involved, and they may be meaningful to a particular neighborhood or region or area, but at the national level, they're not significant yet. But we don't know. We don't know how far that will go. We'll find out much more. I mentioned that you saw we've had two very strong goods inflation readings in the last 2 months, which is very unexpected. I think hard to trace it to specific tariffs, but it must have something to do with, it's either noise and it'll come back, and that's very possible too. But if it is persistent, then it must be to do with people buying ahead of tariffs or raising prices ahead of tariffs and things like that. Those kinds of things happen, and they're very, very hard to capture because so much of it is indirect. A great example is their washing machines were tariffed in the last round of tariffs, and prices went up, but prices also went up on dryers, which were not tariffed. So the manufacturers they just kind of followed the crowd and raised it. So things happen very indirectly, and so there'll be a lot of work done in coming months to try to trace all that through. But ultimately, though, it's too soon to be seeing significant effects in economic data.
Craig Torres from Bloomberg News. Thanks, Chair Powell. You said transitory price increases from tariffs are the base case. Transitory is the base case. Wasn't it the base case last time? And didn't the FOMC forecast lower inflation ahead last time? And wasn't the lesson that it quickly got into services, haircuts, daycare, everything else? And so I'm just wondering why the 9 aren't taking that on board and are cutting twice this year.
When you say last time, are you talking about the last
pandemic? Yes, during the pandemic.
Because you could have been talking about the last time there were tariffs, in which case the inflation was transitory. Yeah, no, of course we're well aware of that, and it's still the truth. If there's an inflationary impulse that's going to go away on its own, it's not the right policy to tighten policy, because by the time you have your effect, you're in effect by design. You are lowering economic activity and employment, and if that's not necessary, you don't want to do it. In real time, as we know, it's hard to make that judgment. And we're well aware, of what happened, obviously, with the pandemic inflation. But I mean, we have to look at this as a different situation. There are differences and similarities. I mean, it's a different time. We haven't had real price stability fully reestablished yet, and we have to keep that in mind. And we hear that people are very reluctant to take on to allow prices to go up. At the same time, we hear that businesses are intending to pass many of these prices through. So it's hard to say how this is going to work out.
Steve Leisman, CNBC. Thanks for taking my question, Mr. Chairman. The Bank of Canada, in its last policy statement, said monetary policy cannot offset the impacts of a trade war. What it can and must do is ensure that higher prices do not lead to ongoing inflation. I wonder if that kind of reflects your own sense of prioritization faced with higher prices and weaker growth, that the idea is you have to take care of inflation.
So we have two goals, right? We have maximum employment and price stability, and we have to balance those. And, there can be situations in which they're in tension, right? And we actually have a provision in our consensus statement that says what we should do in that case. That's a very challenging, situation for any central bank, and certainly for us. And so what we say that we'll do is we'll look how far each of those two goals is, each of those two measures is from its goal. And then we'll ask how long we think it might take to get back to the goal for each of them, and we'll make a judgment, because our tools work in one direction. We're either tightening or loosening. So it's a very challenging situation. Let me say, we don't have that situation right now. That's not where the economy is at all. It's also not where the forecast is. I don't know any mainstream forecasts that really show significant problems like that. So,
Well, just to follow up, yesterday, the UCLA Anderson forecast said there's high probability of a recession. Where do you stand on whether or not the slowdown you're seeing creates a higher probability or concern that you may have on recession? Thank you.
you know, there's always an unconditional possibility of a recession. It might be broadly in the range of 1 in 4 at any time. If you look back through the years, there could be within 12 months a 1 in 4 chance of a recession. So the question is whether whether this current situation, those possibilities are elevated. I will say this: we don't make such a forecast. If you look at outside forecasts, forecasters have generally raised, a number of them have raised their possibility of a recession somewhat, but still at relatively moderate levels, still in the region of the traditional, because they were extremely low. If you go back 2 months, people were saying that the likelihood of a recession was extremely low. So has moved up, but it's not high.
Chris.
Hi, thank you. Chris Rugaber at Associated Press. As you know, I guess last night, President Trump fired 2 members of the Federal Trade Commission, an independent agency, and this could cause the kind of legal fight about the administration's power to fire independent people. If those firings stand, is that a threat to the Fed's independence? Could he do the same thing to the Fed board?
So I think I did answer that question in this very room some time ago, and I no desire to change that answer and have nothing new for you on that today.
Well, maybe I'll have another mulligan. As you know, I wanted to go back to the consumer sentiment, particularly the inflation expectations in the University of Michigan survey. In the summer of 2022, you cited the rise in the long-term inflation expectations in that index as the reason that you went big with a 3/4 point hike. So I know you've talked about all the different measures now, but you seem to not be placing the same weight on that. And so I'm just wondering, are you dismissing what we saw last week from the University of Michigan, or does that carry the same weight as it did in the past?
So I mentioned it back then, but in no way did I place a huge weight on it. I think that was a ex post story, but it wasn't the case. That was a preliminary reading, and so is this. And it's also, this is that Michigan, the one you're referring to, the longer term thing. We look at it, we don't dismiss data that we don't like, we force ourselves to look at it, but it is an outlier compared to market-based and compared to other survey-based assessments of longer run inflation expectations. So we got to keep that in mind. And I would just say we look at all of them, and that one's kind of an outlier, but nonetheless we take notice of it.
Michael McKee from Bloomberg Radio and Television. There's a worry on Wall Street that when you want to study the net effect of the fiscal policies we may see on the economy, that you would end up waiting too long and be behind the curve in responding to a downturn. How can you reassure people that you can spot a problem early enough unless you decide to be preemptive?
Yeah, look, we're aware of we're well aware of how things are going to evolve and the timeframes and all that, and we will use our tools to foster achievement of our goals to the best we can, and of course we're going to try to be timely with that. For right now, the hard data are pretty solid. We are.
Government by tweet? I mean, do you have a feeling that at some point you actually will have a forecast you can trust?
Yes, I think we will. It's hard to say when that will be. These decisions are going to be made and they're going to be implemented, and then we'll know. At that point, we'll know what the decisions are, and we'll have to make assessments then about the implications for the economy. Those things will happen. A lot of them will happen over the course of, in coming months, certainly over the course of this year, and we'll be adapting as we go.
Hi, Chair Powell. Rachel Siegel from the Washington Post. Thank you for taking our questions. At the beginning, you were talking about separating the signal from the noise and tariff inflation from non-tariff inflation. Can you walk us through what that looked like over the last couple of months, if there were specifics from the January meeting to now that helped you make those distinctions?
So when we say separating the signal from the noise, that's just a way of saying that things are highly uncertain, and that, you know, you're reading about developments. The news is full of developments of tariffs being put on and taken off and things like that. Some of that is noise in the sense that it's not really telling you anything. You're trying to extract a signal from that, and the signal is what's going to be the effect on economic activity, on inflation, on employment, and all those things. So that's really when we say signal and noise. Sorry, the second thing was?
Or similarly for tariff inflation, non-tariff inflation distinction.
That's sort of a special case of that. You know, the idea being, and I do think that the first 2 months of this year are a great example. You've got high readings for goods inflation after a string of readings that average close to zero, and you have to ask, it's coming during tariffs, but you know, you can't. It's very hard to actually scientifically go back and match up those increases and say, yes, I can prove that that's from tariffs, but it kind of has to be to some extent. Plus noise. There can be idiosyncratic readings in various categories, which will shortly reverse, and that happens too, and that could be a big piece of it. You know, I think we'll know in a couple of months. We'll know whether those were, you know, where that really was from. But that's another case where I think it's going to be very, very challenging to unpack the inflation that we see over the course of this year and be able to say with confidence how much of that came from inflation and how much of it, from tariffs, and how much of it didn't. But that's what we'll be doing. We'll be doing that, and so will everybody else, and we'll all be trying very hard to make that assessment. And, you know, I'm sure we will make a lot of progress on that, and we already have. But it's going to be a challenge.
Do you have a sense yet as to what, in your mind, would make something cross from noise to a signal, what that threshold would look like?
You know, it would depend on what we're talking about. I mean, obviously, direct evidence that particular pieces of inflation are or are clearly not caused by tariffs. For example, if it's something that was, you know, in the service sector that was far away from anything that's tariffed, you might think, okay, well, that is, like, frankly, housing services inflation, which by the way has been behaving well, you know, which for some time was kind of our problem. Now it's slow, but it's definitely, you know, moving down in a very good way. It's more now with goods and to some extent with non-housing services inflation.
Thanks for taking our questions, Chair Powell. Kelly O'Grady, CBS News. So consumer sentiment has dipped dramatically, but you say the economy and the hard data is still solid. What is your message to consumers that clearly disagree and don't feel that strength? Because the hard data they're looking at is their grocery bill.
Okay, so a couple things. The grocery bill is about past inflation, really. There was inflation in 21, 2, and 3, and prices went up. The current level, it's not the change in prices, it's they're unhappy, and they're not wrong to be unhappy that prices went up quite a bit, and they're paying a lot for those things. So I think that is the fundamental fact, and has been for a long time, a couple of years, why people are unhappy with the economy. It's not that the economy is not growing. It's not that inflation is really high. It's not that unemployment is high. It's none of those things. We have, 4.1% unemployment. We've got 2% growth, and it's a pretty good economy. But people are unhappy because of the price level, and we completely understand and accept that.
And just to follow up, why are you still projecting 2 rate cuts this year if your own projections show inflation higher for longer? Does that mean you see a slowdown in economic growth as a real threat?
So I think remember we came into this with, at the December meeting, the median was 2 cuts, the median was. And so you come in and you see, broadly speaking, weaker growth but higher inflation. And they kind of balance each other out. So you think, and unemployment is there's really only a 1/10 change. So there's just not a big change in the forecast. There really isn't. Modest, meaningfully higher growth and meaningfully higher inflation, which call for different responses, right? So they cancel each other out, and people just said, okay, I'm going to stay here. But the second factor is it's so highly uncertain. Is just, we're sitting here thinking, and we obviously are in touch with businesses and households all over the country. We have an extraordinary network of contacts that come in through the reserve banks and put in the beige book, and also through contacts at the board. And we get all that, and we do understand that sentiment has fallen off pretty sharply. but economic activity has not yet. And so we're watching carefully. So I would tell people that the economy seems to be healthy. We understand that sentiment is quite negative at this time, and that probably has to do with turmoil at the beginning of an administration that's making big changes in areas of policy, and that's probably part of it. I do think the underlying unhappiness people have about the economy, though, is more about the price level.
Victoria. Hi, Victoria Guido with Politico. I wanted to ask, first of all, if you could clarify, you were talking about how tariffs were a good part of the uptick in the inflation forecast, and I was just wondering what that specifically refers to. Is that the tariffs that have already been put in place? Is that anticipating some of the tariffs that might be coming on April 2nd? And then also, if you wouldn't mind, talking a little more about the balance sheet decision and what drove that. Did that have anything to do with expectations of how the debt ceiling, raising the debt ceiling, might affect the reserve supply?
Yeah. So in the SEP, you'll see that there's not further progress on core inflation this year. We're kind of flatlining, going sideways. We don't ask people to write down how much of this is from tariffs and how much of it is not, but some of it is from tariffs. We know that tariffs are coming in. We know that they're probably already. All forecasters have tariff inflation affecting core PCE inflation, core CPI inflation this year, without exception. I'm not aware of an exception. So it's in there. I can't tell you how much of that it is. In terms of the balance sheet, so yeah, I think, I guess the way I'd say it is, it was the flows in and out of the TGA that got us thinking about it. But as we thought about it, we really came to the view that this was a good time to make the move that we made. And broadly committee that came around to the view that we would do the same thing we'd already done, which is I guess in June, was it June, whatever it was, we lowered the pace of QT, and we're just going to do that again. We're going to cut it roughly in half. And the sense of that is, if you're cutting the pace of QT roughly in half, then the runway is probably doubled. Okay, so it's going to be slower for longer, and people really like that. People thought that's a good idea. It's like a plane. You can think of it like a plane coming in for a landing.
I really like that.
As we get closer, and we by the way, we still think that reserves are abundant, although you begin to see some of the things we look at begin to react a little bit, but we still think that they're abundant. And of course, now the TGA is emptying out, so reserves are higher now, so you can't really see the underlying signal. So we came around to the view, and it had a lot of appeal, and so we did it. It has no implications at all for monetary policy. It has no implications at all for the ultimate size of the balance sheet. It isn't sending a signal in any hidden way that you can try to tease out. It's just not there. We're basically, it's very consistent with our plans and our practices that we've published and that we've followed since we began this, what is a very successful, rundown of the balance sheet. Again, the second time that we've slowed the pace, and we've said that we would stop when we were somewhat above the level we judge as ample. And clearly we're not at that level yet, but we're going to be approaching it more slowly.
So it looks like Powell is still going and he's answering questions, but they're mostly the same questions that are just trying to get him to say that the economy is slowing and all of that, so they can take a headline and run with it, right? That's what it seems like to me.
Yeah. They want. So I got to go real quick, but I'll give you the quick and dirty here of what I take away from this as, I've had a little bit of experience in traditional markets and in finance and stuff like that. Essentially, this is all to say, no change. We're going to continue to slow QT to the point where it stops, and then we will pivot not necessarily to QE, but to rate cuts. I think you said 3.8 by the end of this year, and then possibly 3.4. I think it's going to end up being more accelerated than that. Now, what are they trying to pin him on with the tariffs? They're trying to get him to say the tariffs are bad, essentially, and he's not taking the bait. One of the things is they're only concentrating on asking questions about how tariffs can cause inflation, and they're disregarding the deflationary aspect of tariffs as well on the other side, and the deflation that we're seeing here at home via the implementation of these tariffs. So core PCE and like all this other stuff that they're trying to concentrate on is simply so that they can have talking points to bash Trump over the head with when it comes to tariffs in the coming weeks, especially in the run up to the end of the quarter and Q1 of quarter two, which is going to be, full implementation of reciprocal tariffs. The market is smarter than this, and they're not buying the bait questions. Powell is speaking in exactly the manner in which we thought he would, and that is, the key point, the key takeaway is the slowdown in QT. So although he didn't really say much, the stressing of the slowing of QT.
Right, which the market seems to be responding to in a positive way. Bitcoin's up, most cryptos up, not crazy up, but up. So the market seemed to be responding in a way that they're happy with it. This is what they were expected. There was no frightening news that came out of this, so that's actually a good sign.
Business as usual. Yeah,
right. Business as usual is better than bad news. So thank you guys for tuning in. Thank you everyone for coming out. Definitely follow DeOrganized at DeOrganized BTC on X, at DeOrganized on YouTube. We try to bring you these news and events as they happen when we can. We have a great group of guys on here. What's up, Wagme? Thank you for joining us. Thank you to everyone else. I saw Chad Stacks in the house. Ace in the place. Reese came on with us. Landy, as always, great stuff. Jack, great stuff, man. GPSC. We are actually going to run over to the building on Bitcoin space on X. It's actually Odin.fun and Liquidium AMA with Bitflow. We are going to go get in there and join our community brothers and hear what they are talking about over on X. And again, thank you all for tuning in to DeOrganized and patronizing our platform. We love y'all. Y'all have a blessed day.
Yeah,
Peace
and
out.
if you wanted to join that space, it is Bitflow_finance. Go jump into that space. Building on Bitcoin.
And don't forget to tune in to the DeOrganized night show at 7 p.m. tonight with GPSC and friends. Actually gonna probably poke around on some see ya, Jack. Gonna poke around on some DeOrganized games and maybe some other projects that come out and want to show some stuff off.
Yeah, man, we're
take
gonna
it out. Take it out, GP.
Yeah, so tune in at 7 p.m. ET for another awesome episode of DeOrganized Nightly, where we get your favorite GigaBrain astronaut scholars in the same room and have a dope conversation and kick out high frequency vibes. We are DeOrganized Media. We give you some live coverage of Jerome Powell speaking during the FOMC meeting with some of our favorite community members from the Stacks ecosystem. Be sure to get yourself some Stacks, get in the game. Of course, not financial advice, and do your own research. Stacks is the premier Bitcoin layer 2, bringing programmability to Bitcoin. Head over to the Bitflow spaces and get integrated into an awesome community full of base chads. I will see you guys on the flip side. Tune in tonight for more awesome.
Thank you.